Imagine you were watching a massive market trend. I mean, it has been moving in one direction for weeks, maybe even months.
Yeah.
Everyone is talking about it.
Oh yeah, the institutional desks are all positioned on the exact same side.
Right. The retail crowd is finally catching on, and you look at your charts, and it's this relentless, almost vertical ascent. It just feels unstoppable.
Untouchable, really, until, it isn't.
Exactly. Then suddenly it stops. The chart just flatlines, the price goes completely sideways, and all that momentum vanishes into thin air.
Which is when the panic sets in.
Totally. Do
You
you
said-
panic? Do you sell everything you own? What if that agonizing, boring sideways pause isn't actually the end of the trend, but exactly what the market needs to keep going?
It is the ultimate psychological torture chamber for market participants, honestly. When the velocity dies, our natural human instinct is to assume the fundamental thesis has died right along with it. But confusing a deceleration of price with a true reversal of a trend well, that is exactly how you end up exiting a generational wealth-building campaign right before the biggest move actually happens.
Okay, let's unpack this. Because our mission for this deep dive today is to completely rewire how you, sitting at home, look at stalled momentum in large market campaigns.
It's a crucial mindset shift.
It really is. We are going to decode the hidden structural rhythm of markets and figure out why a pause is rarely a true turning point. So to frame this, think about a marathon runner.
Okay, I like this.
When a runner slows down to a walk at, say, mile 18, are they collapsing from total systemic exhaustion? Or are they just tactically catching their breath so they can sprint the final 8 miles?
Right, they are managing their energy.
Because if you misdiagnose a tactical breather as a total collapse, your entire thesis is broken. You bet against the runner and you lose.
What's fascinating here is how universal this misdiagnosis is. It really does not matter if we are talking about retail day traders in their basements or sophisticated hedge fund managers in high-rises.
They all fall for it.
They absolutely all fall for it. Misinterpreting a stalled market is one of the most common mistakes participants make. The core thesis we have to establish today is that a lack of forward movement does not automatically mean a reversal is happening.
It just means a pause.
Exactly. The very structure of financial campaigns dictates that price will frequently stop advancing. But crucially, it also fails to move decisively in the opposite direction. It just stalls.
And that flat line creates this massive psychological trap for us. Let's look at the misinterpretation of the flat line. Like, why do we constantly misread this?
It's biological, really.
Is it? Because when momentum slows down after a long trend, the knee-jerk human reaction is just to expect a total catastrophic reversal.
Right.
We look at flattening charts, we see sideways price action, and we just incorrectly declare the whole campaign is dead.
Yeah, it boils down to what we call the straight line fallacy. Humans are just notoriously bad at processing nonlinear functions.
We just want things to go straight up or straight down.
Yeah, right. We project recent, immediate history infinitely into the future. If a market has been climbing at a 45-degree angle for 60 days, we start pricing in that exact same trajectory for the next 60 days.
Get used to the speed.
We do. And when the market stops, our brain signals a catastrophic failure of the pattern. We look at the order book, we see the massive buying pressure evaporate, and we assume the buyers have just permanently left the building.
We assume the underlying campaign is just fundamentally over. But I have to challenge this premise a little bit, though.
Go for it.
Because if I'm driving a car at 90 miles an hour, right, and I take my foot off the accelerator, the car slows down. The momentum decays.
Sure, basic physics.
Yeah, eventually friction and gravity take over, and the car stops. The energy leaves the system entirely. So why isn't the market the exact same mechanical reality?
It's a great question.
I mean, if the aggressive buying pressure that fueled the trend stops, shouldn't the natural gravity of sellers taking profit pull the price right back down? Like, why doesn't the vacuum of buyers immediately result in a collapse?
Because financial markets do not operate on the simple physics of momentum and friction.
They don't.
No, they operate on the mechanics of capital deployment. Capital is not a singular physical force like kinetic energy in a moving vehicle. Market campaigns never move in straight lines because institutional capital, I'm talking sovereign wealth funds, massive asset managers, central banks.
The real whales.
The whales, they are never dumping their capital into the market in a single massive wave.
Wait, really? So you're saying a $1 trillion asset manager doesn't just hit buy at market on a Tuesday morning and create a 6-month trend?
Oh, exactly the opposite. Imagine if an institution with, say, $50 billion to deploy in a specific currency pair or a commodity market, executed that order all at once.
So it'd be chaos.
Complete chaos. They would completely destroy their own entry price. They would cause a massive liquidity shock, driving the price up exponentially in seconds, and their average cost basis would be entirely ruined.
So they'd be buying at the absolute worst possible prices.
Right. So instead, they use complex algorithms, things like volume-weighted average price or VWAP, to slice that massive order into thousands of smaller orders over weeks, sometimes months.
Oh, wow. So it's a slow drip.
A very strategic slow drip. They buy until they push the price to a certain upper threshold, and then they just step back.
You just stop buying entirely.
They stop, they let the price drift, they let the retail sellers step in, and they wait for liquidity to build up again. This institutional execution process naturally produces waves.
Oh, okay.
You get a wave acceleration as capital flows in aggressively, which is then followed by a necessary stall.
Now, here's where it gets interesting. Because if capital enters the market in these distinct algorithmic waves, it really begs the question, what do these waves actually look like on a macro scale?
Right, if you zoom all the way out.
Yeah, zooming out, these major market campaigns essentially play out as a three-act play. Act 1 is directional expansion, Act 2 is liquidity consolidation, and Act 3 is continuation or structural transition.
And breaking down those three specific phases is exactly how you survive the chop.
So let's break them down. Phase 1.
The first phase, directional expansion, is what attracts all the media attention. This is driven by massive macro incentives.
Like what? Give me an example.
Well, perhaps it's a structural shift in global interest rates,
Mm-hmm.
or a geopolitical supply shock in energy markets, or even a massive technological breakthrough.
Right, like an AI boom or something.
Exactly. These macroeconomic tectonic plates shift, and capital is essentially forced to reallocate globally. This produces that sustained, aggressive price movement we all recognize as a bull market or a bear market.
I mean, phase 1 is the easy part, right? The macro narrative is obvious, the trend is your friend, and everyone making money looks like a genius.
Everyone is a genius in phase 1.
But then we hit phase 2, the liquidity consolidation, the crucial pause. The market just stops advancing. It absorbs opposing flows. It adjusts positions. And this phase, you're saying, is an absolute structural necessity.
Without doubt.
The market has to stall.
It absolutely needs to stall to survive. Continuous, unrelenting price movement just exhausts the available pool of market participants. Think about the order book depth for a second.
Okay.
As a price skyrockets, the available resting limit orders to sell are entirely consumed.
Because everyone who wanted to sell already sold to the buyers.
Right. Eventually, you run out of willing sellers at those elevated prices, which violently drains liquidity from the system entirely. And when liquidity drains, volatility spikes to completely unmanageable levels.
It gets reckless.
Very. Without a consolidation phase to restore that order book depth and bring new participants into the market, trends would just burn out and collapse under their own weight.
It's kind of like a sponge soaking up a massive spill on a kitchen counter.
Right. I love that analogy. Yeah.
Because there's a physical limit to how much liquid that sponge can hold.
Yeah.
If you just keep wiping, eventually it stops absorbing anything and just smears the water around the counter. You have to stop, go to the sink, wring out the sponge, and reset its capacity. So the market is essentially wringing out the sponge. It is digesting the previous move, it's clearing out the weak hands, and resetting the liquidity pool.
That is the perfect mechanism to visualize. If a market forces a trend without wringing out the sponge, without consolidating, it crashes.
The structural integrity just fails.
Yes. The consolidation allows the market to build a dense layer of volume at a new, higher price level. It basically creates a floor. It restores equilibrium so that the next leg of the journey actually has a solid structural foundation to launch from.
So we know a pause is just the market wringing out the sponge. Let's look under the hood of a stall.
Let's do it.
What exactly is happening in the internal plumbing of the market during that consolidation process? Let's start with liquidity absorption. As a trend gets crowded, it gets incredibly sensitive, right?
Highly sensitive. As a campaign progresses, it becomes consensus. The financial media is covering it nonstop, retail traders are piling in on their apps, and the trade becomes what we call crowded.
Everyone is on the same side of the boat.
Right. And when a trade is crowded, pushing the price even 1% higher requires a disproportionately massive influx of new capital. The consolidation phase, the stall we keep talking about, is where the market absorbs counterflows.
Counterflows from who, exactly?
Well, you have early participants taking profits, you have counter-trend traders actively trying to short the top, and you have massive hedging activity.
So the market really needs to absorb all that selling pressure.
Yes, and it does so without collapsing. The price simply stops going up. It fluctuates within a tight range because the massive underlying institutional demand is quietly acting like a bid wall, just eating up all those opposing sell orders.
Wow. So the sellers think they are calling the top.
But they are actually just providing the necessary liquidity for the big players to accumulate more of the asset at a stable price.
That is wild. And while that liquidity is being absorbed, you also have institutional position management happening in the background. Because the massive funds driving these trends don't just operate on a set-it-and-forget-it mentality, do they?
Not at all. They have strict, mathematically mandated rules they have to follow. Portfolio managers are governed by rigorous risk models. Typically, these are value at risk, or VAR models.
VAR models, right?
Yes. They also manage to strict volatility targets and allocation limits. So, let's say a fund has a firm mandate that no single asset class can represent more than 10% of their total portfolio risk.
Okay, makes sense.
Now, if they bought into a massive macro campaign early on and the asset appreciates by 50% in 2 months, well, that asset has now violently breached their maximum allocation limit. It might now represent 15% of their portfolio risk.
So they're contractually obligated to sell.
Exactly. Even if they still absolutely love the asset, their own internal risk ledger forces them to trim the position to get back down to that 10% threshold.
But the real story is, these institutional adjustments do not reflect a change in directional bias, which is huge.
Right. It is the ultimate trap for retail observers. They see a massive regulatory filing showing a hedge fund dumping millions of shares, or they see these huge block trades hitting the tape, and they immediately assume the smart money is abandoning the trade.
They think the insiders are running for the exits.
But in reality, the institution is just executing prudent risk management. They are rebalancing.
So wait, a giant fund actively selling their position into the market isn't them turning bearish. It's literally just a mechanical adjustment.
That's it. It is tactical profit-taking and portfolio rebalancing. The traders who built their positions early in phase one have secured massive gains. They are going to take some chips off the table to lock in their quarterly performance bonuses and protect their downside.
Sure, you can't blame them for that.
But, and this is the vital distinction you have to understand, they are not fully exiting. Their core positioning, the foundational thesis of the campaign, remains completely intact.
They still believe in the macro driver that started the whole thing.
Exactly. The market pauses, it absorbs this tactical selling, but it doesn't reverse because the heavy structural long positions are still firmly in place.
Okay, so we have the internal mechanics causing a stall, we have the risk model rebalancing, tactical profit-taking, and the absorption of counter-trend liquidity.
The internal plumbing.
Right. But markets don't exist in a vacuum. What about the outside interferences? What external macro catalysts force the market to hit the pause button?
Well, external events are really the primary triggers for phase two consolidations. The most frequent catalyst by far is upcoming policy decisions. Think of the periods leading up to major central bank meetings.
The Federal Reserve, the ECB, the Bank of Japan.
Right. The periods right before those meetings.
It's the ultimate fog of uncertainty. I mean, when the Fed goes into its blackout period before an FOMC meeting, the primary dealers have to adjust their gamma exposure, which inherently suppresses volatility. The stall is practically mathematically mandated by the system.
You've hit the nail on the head regarding dealer positioning there. When a central bank is preparing to release a new policy statement or update their economic projections, like the Fed's dot plot, it paralyzes institutional capital.
Nobody wants to make a move.
The risk-reward ratio of initiating a massive new position the week before a central bank meeting is terrible. Institutions freeze new positioning. They require clarity on the cost of capital before they commit billions of dollars.
This raises an important question, though. How do participants actually behave during these blackout periods? I mean, they don't just liquidate their portfolios and go entirely to cash, right?
No, they don't. They maintain their existing positions rather than expand them. They might hedge the tail risk, perhaps by buying options, but they essentially just sit on their hands.
And when the major liquidity providers sit on their hands, the market momentum just dies. You get a stall.
Exactly.
And it's not just central bank policy. Geopolitical uncertainty plays a massive role here, too. Diplomatic negotiations, military tensions, or sudden regional conflicts force the market to wait and evaluate.
Just look at how energy markets respond to geopolitical shocks.
Oh, instantly.
Capital is highly sensitive to geopolitical tail risks. When an event occurs that creates a massive spectrum of unknown outcomes, say a sudden escalation in a key energy-producing region capital retreats from the frontier of risk.
It pulls back to safety.
Yes. The market immediately enters a consolidation phase while sovereign wealth funds, commodity trading advisors, and quantitative models try to literally price in the probability of supply chain disruptions.
They have to wait for the geopolitical dust to settle before determining if the overarching campaign is still valid.
Right. And then you have the economic data transitions.
Oh, we've all seen this play out on a Friday morning.
Yeah.
A massive data drop happens, like non-farm payrolls or a CPI print,
Yeah.
and it comes in wildly outside of consensus expectations.
The shock factor.
Yeah. The market just has to pause to reassess the whole narrative. Does this new data reinforce the trend we've been riding, or does it permanently weaken the structural thesis?
Because the market is fundamentally a forward-looking discounting mechanism, it prices in expectations. When a radically unexpected piece of economic data hits the tape, the quantitative models literally have to reprice the probability of future interest rate paths or corporate earnings.
The gears just grind to a halt.
They do. The trend stalls, while the collective intelligence of the market figures out if fundamental reality has actually shifted, or if it was just a statistical anomaly in the data.
All right, so we deeply understand the why of a stall now. We've covered the internal plumbing of risk models and the external shocks of macro data. But how does this actually translate to what you see on a screen?
The visual part.
Yeah, let's talk about spotting the stall on the charts. What does the price behavior actually look like for someone sitting at their desk?
Well, the defining visual characteristic of a stall is range formation. The price stops creating higher highs and higher lows.
The staircase pattern breaks.
Exactly. Instead, it starts oscillating within defined, visible boundaries. It hits a resistance ceiling, gets rejected, falls to a support floor, and bounces back up. This creates a horizontal channel.
It gets trapped in a box, and it just chops back and forth.
It chops aggressively, and this range-bound action can last for weeks. In the largest macro campaigns, it can last for multiple quarters.
Wow.
During this time, you see severely reduced momentum. The technical indicators that a massive portion of the market relies on, things like moving averages, MCD, RSI, they completely flatten out.
They just go sideways, too.
The moving averages entangle with the price, volatility compresses tightly, often creating patterns like Bollinger Band squeezes or volatility contraction profiles.
So what does this all mean for the quantitative funds or the algorithmic traders who rely purely on math and momentum indicators? I mean, if you are running a commodity trading advisor fund, a CTA that strictly trades momentum breakouts, a flat moving average has got to be an absolute nightmare.
It is the environment that completely destroys their sharp ratios. Mechanical, trend-following indicators are inherently blind to structural context.
They don't read the news.
No, a moving average algorithm doesn't know that the Federal Reserve is trapped in a policy dilemma. It only knows the math of its specific look-back period.
It just sees that the speed has dropped to zero.
Right, and because these systems are programmed to interpret a loss of momentum as a trend reversal, they start generating false signals.
Uh-oh.
They trigger cell programs. They literally tell machines the momentum is dead, liquidate the longs, initiate short positions. And this leads to the most dangerous phenomenon of the consolidation phase.
Which is?
The false breakout.
The liquidity sweep, the ultimate retail trap.
It is brutal. In a range-bound market, liquidity builds up on the edges of the box. You have stop-loss orders resting just above the ceiling and just below the floor.
Because everyone puts their stops right outside the range.
Exactly. So what happens is you get a marginal price move outside of that defined range.
Yeah.
It breaks the ceiling by just a few ticks.
And people see that and jump in.
Short-term breakout traders see this and immediately aggressively buy the breakout, thinking the new trend has finally launched.
But the broader institutional campaign structure hasn't actually resolved its consolidation yet.
Exactly. The move wasn't backed by real macro capital. It was just an algorithmic hunt for the liquidity resting above the range. Once those stop-loss orders are triggered and the liquidity is swept, the buying pressure just vanishes.
And then it drops.
The price reverses violently and collapses right back into the middle of the box. The market wasn't transitioning, it was just clearing out the order book imbalances. Anyone who bought that false breakout is instantly trapped underwater.
Man, to really ground this highly conceptual discussion, I feel like we need to look at a concrete historical case study.
Yeah.
We need to see this three-act play happen in the real world.
Let's do it.
Let's examine the massive U.S. dollar appreciation campaign of 2021 and 2022. Because this is the perfect laboratory, right?
Mm.
Currency markets are driven by undeniable heavy macro forces.
The 2021-2022 US dollar rally tracked by the DXY index is a textbook example of campaign structure. Let's look at the setup, the phase one directional expansion. The macro incentives were incredibly clear.
Inflation was surging everywhere.
Right, inflation was surging globally, but the U.S. Federal Reserve pivoted to an extremely aggressive hawkish stance far faster than the European Central Bank or the Bank of Japan.
The Fed started hiking rates by 75 basis points a clip,
Yeah,
which was unprecedented.
precisely. You had massive interest rate divergence. The yield on U.S. Treasuries skyrocketed relative to German bonds or Japanese government bonds. Capital flowed relentlessly into the U.S. dollar to capture that yield advantage.
Institutions piled in.
They piled in. The dollar went on a historic, nearly vertical run. That was Act One.
But then we hit the stall. Mid-campaign, around the summer of 2022, the dollar enters this multi-month consolidation. The aggressive rate hikes are still happening,
Right.
but the DXY just stops going up.
It just flatlines.
Volatility drops. The price chops sideways in this frustrating equilibrium. The macro data, the inflation prints, the hawkish Fed speak. None of that has changed its core trajectory, but the price action flatlines.
And this is exactly where the trap was sprung. Market participants looked at this incredible historical run, saw the stall, and that straight line fallacy kicked in.
They couldn't process the pause.
They assumed the dollar was exhausted. A narrative took hold that peak inflation is here, and the Fed would immediately pivot to cutting rates.
And so they aggressively bet against the underlying structural trend. They started shorting the dollar right in the middle of a massive consolidation, trying to catch the top.
They faded the pause, and then phase three kicked in.
The continuation.
Over the next few months, the economic data continued to roll in, confirming that inflation was deeply entrenched. The Fed made it absolutely clear they were not pivoting.
The original macro incentives, that interest rate divergence, were still completely intact.
The underlying reasons to own the dollar had not vanished. The market had simply spent 3 months wringing out the sponge and absorbing profit-taking.
So the dollar breaks out of the consolidation range to the upside, the massive trend resumes, and we see the DXY push toward generational highs later that year.
And it absolutely devastated all the counter-trend traders who shorted the stall. They were forced to cover their short positions, which actually added fuel to the upward breakout. It was a classic short squeeze born entirely out of misinterpreting a structural pause.
Wow. The lesson here is paramount for you listening. Treating a structural reset as a total reversal is the absolute quickest way to end up on the wrong side of history.
Definitely.
If the macroeconomic foundation of the house hasn't changed, don't bet on the house collapsing just because the builders took a lunch break to review the blueprints.
That's a great way to put it. The consolidation phase was merely a structural reset. The institutions were managing their VAR models, adjusting to the new higher volatility regime, and absorbing the retail selling.
Traders who interpreted the stall as the end of the campaign were financially slaughtered.
While those who recognized it as a necessary liquidity consolidation patiently held their core positions and captured the final massive leg of the move.
So if stalls are a normal, entirely predictable part of market rhythms, if we can scientifically explain the internal plumbing of risk models and the external catalysts of central bank policy, why do brilliant people constantly get this wrong?
It's a great question.
Let's dive into the psychology of the trap. Why is human hardware so incompatible with market structure?
It fundamentally comes down to dopamine and trend-following bias. We get physiologically addicted to the easy momentum of phase one. When a market is trending cleanly, it is chemically rewarding to the human brain.
I mean, every day you check your portfolio, your P&L is green, you feel intelligent, you feel validated.
The market is handing you constant positive reinforcement.
Exactly.
But when that dopamine hit of daily momentum suddenly stops, we experience psychological withdrawal.
We literally go through withdrawals.
We do. We assume the game is over because the immediate reward mechanism has vanished. We conflate a lack of daily excitement with a lack of underlying structural strength. Furthermore, there is massive institutional career risk at play here.
Okay, explain that. Because we usually think of institutions as these cold, calculating machines that don't feel emotion.
Right, but they are run by human beings who desperately want to keep their jobs. During a volatile consolidation phase, a portfolio manager's Sharpe ratio, their risk-adjusted return, starts to decay.
Because the asset isn't moving up anymore.
Right, their daily P&L chops up and down. The pressure from their investors or their risk committees mounts. The psychological pain of enduring a 3-month sideways chop often causes them to liquidate perfectly good long-term positions just to stop the daily emotional bleed.
Just to stop having to answer uncomfortable questions in board meetings.
Exactly. And as we touched on earlier, there is this immense over-reliance on technology. We want the algorithmic model to tell us what to do.
But blindly trusting a mechanical system that is optimized for trend following during a mean reverting consolidation phase leads to death by 1,000 cuts. You are letting a math equation that only understands velocity dictate your strategy in an environment where velocity has intentionally paused.
If we connect this to the bigger picture, the root of all of this error is psychological impatience. Humans inherently abhor waiting.
We hate it.
We crave action. Extended sideways movement tortures market participants because it forces them to be inactive.
Because doing nothing feels like a failure of process.
Yeah.
If you aren't clicking buttons, you aren't trading.
That is the grand illusion. The absence of momentum implies to the impatient mind that a directional change must be imminent. This impatience leads to overtrading, which degrades capital through transaction costs and bad entries.
You just slowly bleed out.
Our desire for constant action fundamentally conflicts with the market's requirement for patient liquidity digestion. Emotional discipline and the ability to just sit quietly on a position are just as critical, if not more so, than the ability to build a discounted cash flow model.
Okay, we've diagnosed the problem. We've exposed the psychological pitfalls of dopamine withdrawal and career risk. Now let's give you, the listener, the actionable tools. We need the ultimate checklist.
Let's go through it.
How do you actually tell the difference between a temporary pause and a genuine structural turning point? Item number 1 on the checklist. Check the structural incentives.
This is your macroeconomic bedrock. You have to ruthlessly audit the fundamental drivers. Ask yourself, are the original macro forces that started this trend still intact?
Look at the real yields. Look at the term premium. Look at the supply-side dynamics.
Exactly. Why did this asset start moving in the first place? If it was driven by a central bank tightening cycle, has the central bank explicitly signaled an end to that cycle?
If you bought the dollar because the Fed was hiking aggressively and the Fed is still projecting further hikes on their dot plot, well, the macro story hasn't changed just because the DXY went sideways for a month.
Precisely. If those overarching structural forces have not mathematically reversed, then the campaign is highly likely to continue. It is simply wringing out this sponge.
Okay, item number 2 on the checklist. Watch the liquidity behavior. How is the order book actually reacting to shocks?
This requires looking beneath the daily closing price and really analyzing volume and order flow imbalances. In a true fundamental reversal, when the trend is actually dying, moves against the trend are violent and amplified.
The selling pressure is aggressive.
It's aggressive, cascading, and it triggers widespread panic. The bids completely disappear, but in a stall, moves against the trend are quietly and efficiently absorbed.
Right, you might see a sudden 2% drop on an intraday basis, but the price doesn't collapse further. It just gets bought back up into the range.
That absorption is the massive institutional tell. It suggests that the underlying campaign still commands significant capital support. The big players are viewing those intraday dips not as the start of a bear market, but as a liquidity event to quietly accumulate more of the asset at a favorable price.
And item number 3 on the checklist, look for cross-market confirmation. You cannot analyze a massive macro trend by staring at one single chart in a vacuum. You have to look at the entire board.
Absolutely essential.
Look at the bond market, look at equity sectors, look at commodity pricing. Are they still supporting the overarching narrative?
Because markets are deeply interconnected systems, they are all pricing in variations of the exact same global macroeconomic realities. If a currency pair stalls, but the sovereign bond market is still screaming that the original macro thesis is correct, say short-term yields are still rising, then you have a massive structural clue.
It's confirming your bias.
Yes. If energy commodities and cyclical equities are still behaving exactly as they should under your original thesis, then your specific asset stall is just a localized temporary pause.
It's exactly like checking the weather, you know?
How's
Well, if you want to know if a brutal, freezing winter is finally over, you don't just stare at the thermometer outside your kitchen window. The thermometer might tick up a few degrees for one sunny afternoon, but that doesn't mean spring has arrived.
Right, it's just one data point.
Exactly. You have to look at the barometric pressure, you have to look at the prevailing wind direction, you have to look at the high-altitude cloud formations on the radar.
Look at the whole system.
Yeah. If the barometer is still plunging and a massive cold front is visible on the radar, Winter isn't over just because you got an hour of sunshine. You need the cross-market confirmation before you pack away your coat.
That is a brilliant framework. The thermometer is your localized price chart. The barometer and the radar are the cross-market confirmations and the underlying structural incentives. You have to synthesize all of them to understand the true climate of the market.
Let's zoom out for a second, because we have covered incredible dense ground today. We started with that terrifying flat line on the screen, and we've mapped out exactly why it happens, how institutional VAR models mandate it, how to spot the false breakouts, and how to survive the psychological torture.
We've been through the whole cycle.
What is the ultimate strategic takeaway for the listener?
The ultimate takeaway is that patience is a mathematical and structural advantage. In massive market campaigns, consolidation is not a failure of the trend. It is a vital, necessary feature of the trend.
It's a feature, not a bug.
Attempting to fade every single pause, assuming every sideways stall is a grain reversal, will just result in a slow, painful death by 1,000 cuts to your portfolio.
So what should they do?
Your primary task during a stall is not to trade the chop, but to monitor the macro drivers. If the structural foundation persists, the probability of continuation remains incredibly high.
Markets rarely, if ever, move in straight lines. They breathe, they expand, and they consolidate. Going forward, whenever you're watching a massive campaign unfold and you see that velocity suddenly vanish, your first instinct should no longer be panic.
It shouldn't be fear.
It shouldn't be an immediate assumption of a crash. Instead, your very first instinct should be to audit the underlying structural drivers.
Stop reacting to the lack of speed on the surface and start investigating the integrity of the foundation.
And I want to leave you with a final provocative thought to mull over today.
Let's hear it.
We've spent this entire deep dive analyzing high finance, quantitative models, and macroeconomics. We've talked about how these massive, complex systems require periods of consolidation.
Right.
They desperately need sideways movement to absorb new information, to wring out the excess, and to maintain their structural integrity for the next big directional push.
Yes.
But think about this. Doesn't human learning and personal progress require the exact same architecture?
Oh, that's interesting.
We have this societal expectation that our careers, our intellect, our personal growth should just be this endless upward directional expansion, a straight line to the top.
But we all know that's not how life works.
Exactly. But the next time you feel like your own progress in life is stalled, the next time you feel like you are just moving sideways, trapped in a range, and the momentum is gone, ask yourself, are you actually reversing, or are you just in a necessary structural consolidation phase?
Wringing out the sponge.
Right. Are you just taking the required time to absorb your recent gains, internalizing the hard lessons, and building the structural integrity you need before your next massive breakout? Keep building that foundation. We'll see you on the next deep dive.